Shareholders, investors, investor representatives, the board, management, staff of Safaricom, members of the Fourth Estate, online community, and invited guests. I don't normally read speeches, so this is a very new one for me, okay? So it is with great pleasure that on behalf of the Safaricom Board of Directors, I formally welcome you to the announcement of our full year results for the financial year ending 31st of March 2018. This event is an important occasion in our calendar and an opportunity for us to update you on our performance, our strategy, the industry landscape and regulatory environment, and the economic factors affecting our operations. Last year was a difficult period for businesses all over the country. According to official reports, Kenya's economic growth slowed to 4.9%, fueled by political uncertainty as the country dealt with the effects of a prolonged electioneering period. The credit market also recorded the slowest growth in 14 years, attributed to the interest rate capping and the reduced economic activity. Thank goodness we didn't have a third election. In addition to that, consumers bore the brunt of high food prices occasioned by the persistent drought, which negatively affected agricultural production and strained household budgets. Government reports show that the information and communications sector expanded by 11% in 2017. This strong performance was supported mainly by the growth in the digital economy, mobile telephony, e-commerce, online training, tax administration, amongst others. Ladies and gentlemen, on the competition front, we have read reports about a proposed merger between two of our competitors. We've also seen the entrance of new players in the industry, both telco and non-telco. These developments are evidence of a highly dynamic market whose biggest beneficiary is undoubtedly the customer. We continue to observe with great interest changes in the regulatory environment, which will continue to be an area of focus for us as we evaluate our position in the light of recent telecommunication recommendations put forward in the draft industry study commissioned by the Communications Authority. The competition study, which was carried out by Analysis Mason, proposes a number of interventions which are of serious concern to us at Safaricom. These include attempts to change the rules of the game by introducing price controls and regulated infrastructure sharing. While yet to be agreed and implemented, the mere fact that these suggestions have been brought forward is an indication that we could be heading into an area where success, rightfully earned through well-structured market strategy, innovation, and investment, is penalized. Our position is that operators should be left to negotiate infrastructure sharing agreements in commercial terms, as is happening already. Introduction of price controls on infrastructure sharing arrangements run the risk of players abandoning investing in their own networks as they wait to be hosted, eventually hurting customers and the country standing as a leader in innovation. The draft study report also contains recommendations such as the requirement that Safaricom can only roll out services replicable by competitors and others seeking to curtail our ability to advertise and create promotions targeted at various consumer segments. These recommendations will not only stifle our ability to innovate for our customers and limit our reach, they also leave us wondering how such a move could benefit the 40 million plus mobile subscribers in the country, which is what any intervention by the regulator ought to focus on. We have said this time and time again. The telecommunications sector in Kenya is liberal and competitive, and the operators should be left to compete on quality, price, and innovation of services. Attempts to introduce retail price control are retrogressive and anti-consumer and unjustified. In any case, price controls are against the country's market economy policy. And I've said this many times personally as well, if I may add, that those who invest should get the rewards of that investment. Those who don't invest should not. And I think this is what's happening today. In the light of these developments, we continue to engage the Communications Authority in pursuit of more considered outcomes that will lead to a win-win such result for everybody. Ladies and gentlemen, we continue to invest in our business, guided by our brand purposes of transforming lives. This purpose, together with a sustained focus on our three pillars of our strategy, putting customers first, providing relevant products and services, and enhancing our operational excellence, continues to generate favorable results. We see growth in our customer base helping us maintain our leadership position in subscriber market share. More of our customers are now regularly active and are spending more on our products and services. As you will soon see, this has helped us generate strong financial and commercial performance. Looking ahead, we remain steadfast in delivering on our strategy and growing growing shareholder wealth while putting people before profit. It is a long-term strategy that is already paying off, and one that we believe is integral to the growth of this company. We are happy that despite the headwinds, our investors continue to show faith in our ability to deliver sterling performance, with our share at one time trading at an all-time high of 33.50 per share. As I close, ladies and gentlemen, I would like to reiterate that we remain committed to transforming lives, and we continue to listen, innovate, and collaborate. This is the strong commitment of our board, management, and staff, all of whom I wish to give my sincere thanks. Now, before I exit the stage, so you can have the main performance, I would like to leave you all with a little surprise. Please turn your attention to the screens. Asanteni sana, and enjoy the presentation.
Good morning, everyone. I'd like to take this opportunity to join the Chairman in welcoming you all to our 2017 full-year results announcement. Now, as many of you are aware, I've been away from the office receiving medical treatment since October of last year. I've been very fortunate to have a great team of medical specialists attending to me since I came to London, and as you can see, I'm making pretty good progress. I just entered the final phase of treatment and expect to be back in Nairobi as soon as the doctors feel that my immune system is sufficiently robust to withstand the infection risks that are usually associated with airline travel. Now, it's very difficult to say exactly when that will be, but close monitoring by the medical team will continue here in London for a number of weeks to come. In the meantime, I thank you all for your messages of goodwill, prayers, and visits, and I look forward to being back in action in Nairobi soon. That's enough about me for today, so now let's talk about business. Before Joe and Satish take you through the results in detail, I'd like to say that I'm extremely pleased to be presenting to our investors and to stakeholders a good set of results where we finished ahead of the guidance that we gave last year. And to achieve these results, we sharpened our focus on delivering relevant products and services, organizational effectiveness, and putting our customers first, a strategy that was exceptionally well executed, considering the very challenging business climate that last year presented to us, and indeed to many other businesses here in Kenya. We continued our efforts to diversify the business to support revenues generated by voice and SMS. Both Mpesa and mobile data grew in double digits. Voice and SMS report a blended growth of almost 3% year on year. Sustained investment in our network rollout plan played a key role in our growth, adding 562 new 4G sites to our network. Last year, we unveiled a new brand promise, Twaweza, which simply means that when we come together, great things happen. But Twaweza puts us on a new journey to unite with Kenyans from all walks of life to build the foundations of a more resilient Kenya. It presented us with a new way of thinking about our business and our relationship with our country. To build a new dream for Kenya and to offer solutions that connect people to people, people to knowledge, and people to opportunities. Twaweza inspires us to ensure that in our transformative journey, we leave no one behind. As I've said on many occasions, Safaricom is a purpose-driven organization. And so we stand for more than just numbers. We believe that when we place purpose at the center of our companies, profits will naturally flow. In the last financial year, we supported more than 80,000 community projects and built and strengthened partnerships that continue to transform lives across the country. And through these partnerships, we are bringing positive change to communities. In particular, I'd like to call out initiatives such as Mtiba, the mobile health wallet that we launched in partnership with Farm Access and CarePay. Mtiba currently has nearly 1 million users and has paid out over 200 million shillings to cover healthcare costs for ordinary Kenyans. There's also DigiFarm and Connected Farmer, which are delivering sustainable, innovative solutions in agriculture to our farmers through mobile technology. And by purposing to provide such services to Kenya, we achieve both corporate and social goals, providing a sustainable approach to business. Safaricom is what it is today for many reasons, and a strong management team is one of them. I began my medical treatment knowing that I was leaving behind a strong executive team, and the results that we are sharing here today are testament to what happens when we come together. Since January, I've been working very closely with my executive team, both face-to-face here in London and remotely using our virtual private network. In my absence, this is the team that's provided the leadership required to steer our business through a challenging business environment, occasioned by last year's prolonged electioneering period and a tough regulatory environment. I'd like to thank my executive team for their leadership, which has led to the results that we're announcing here today. I'd also like to thank our board chairman, Mr. Nicholas Nyanga, and all of our board members for supporting the team during my absence. I'll now hand you over to Joe and to Satish for a more detailed account of our results. From me here in London, Kwaheri. I look forward to seeing you all in Nairobi very soon.
Thank you, Michael. Thank you, Chairman. Thanks to Bob in his absence. Thanks, Joe. Ladies and gentlemen, good morning. To my friends in Kenya, habari azbuhi karibuni. We delivered this superior performance while still remaining within the range of our CapEx guidance. We're proud that we've delivered the performance despite the macroeconomic headwinds of prolonged elections, drought, lower credit growth, uncertain regulatory environment, to say the least. I will now unpack these results for you in a bit more detail in the following slides. In FY18, our service revenues grew at a strong rate of 10% year over year. In the financial year 17, we had a one-off adjustment resulting in a 3.4 billion upside in profit. Excluding this one-off, underlying EBIT grew at 18.3% year over year. Driven by strong operating performance, underlying earnings per share, or EPS, improved by 19.9% year over year, and free cash flow improved by 27.3% year over year. Thanks to strong cost controls and CapEx monetization, underlying EBIT margin improved by 2.4 percentage points year over year, and CapEx intensity improved by 1 percentage point respectively on an underlying basis. The foundation of our growth, as Michael said earlier on, is the sustained investments we make centered around customer experience. We continue to invest aggressively in 4G and now have more than 1,600 sites, which is 49% more than what we had last year. Our fiber rollout now covers 5,000 kilometers, opening up a world of possibilities in the medium term. We strive to complement the quality of network experience with personalized products and pricing offers, resulting in customers getting much more to use by paying a little bit more. These personalized offers drove reduction of effective pricing per data and SMS by 29% and 12% respectively, with voice prices remaining flat. Data effective prices are down more than 60% over the last 4 years through these personalized offers that we offer to our customers. Mpesa Kadogo continue to drive reduction of Mpesa pricing down 29% year over year, making it more affordable for the Kadogo economy and enhancing usage. The price reduction was quite welcome for our customers who were going through economic headwinds in the last year. Our overall customer growth remained solid, and we added 1.4 million more customers in the course of the year, closing at 29.6 million customers. To explain the drivers of service revenue growth, I would draw your attention to the triangles on the top of the slide. Mpesa and mobile data continue to be the drivers of growth in the year. Mpesa grew by 14% and contributed 3.8 percentage points, and mobile data grew by 24% and contributed 3.5 percentage points of the 10% growth for the year. Contrary to global trends, voice revenues continue to grow and contributed 1 percentage points of the 10% growth that we achieved in the year. I'm very happy to report the growth in fixed data revenues. Fixed data revenues, which is relatively a new business, contributed 0.7 percentage points of the 10% growth for the year. Though, again, a relatively new business, fixed data is already 3% of our service revenue. Over the years, we have successfully managed to expand the portfolio, which builds resilience and strength to our business model. From the pie chart at the bottom of the slide, you can see Mpesa now contributes 28% of service revenue, and mobile data contributes 16% of service revenue, thereby reducing the reliance that we have on voice and SMS revenues. As I mentioned in the previous slide, Mpesa contributed 3.8 percentage points of the 10% growth that we achieved in the year. 2.4 percentage points out of the 3.8 was delivered by traditional Mpesa business, which is person-to-person transfers and withdrawals, and 1.4 percentage points of the 3.8 was delivered by new businesses. You will recall during the half-year result, we looked at the Mpesa ecosystem and called out the changing consumer behavior. 4 years ago, traditional Mpesa businesses contributed 90% of the Mpesa revenue. Since then, the contribution of new businesses, which are growing at a faster pace than the traditional businesses, now contribute 26% of Mpesa's revenue. Mpesa revenue today stands at 62.9 billion shillings, representing 28% of revenues. We maintain a good momentum in our mobile money business by adding 2.1 million customers in the last financial year. We continue our journey to democratize M-Pesa, and during the year, we reduced the fee to merchants for Lipa na M-Pesa by 50% and made transactions less than 200 shillings free. This was to encourage adoption of Lipa na M-Pesa, as we see huge untapped opportunity in this space. Ladies and gentlemen, mobile data contributed to 3.5% of the 10% service revenue growth, or 35% of the service revenue growth. 1.5 percentage points of the 3.5% was driven by increase in active data customers, which means more customers using data, and the remaining 2% was driven by improvement in ARPU, or increase in average revenue per user, which grew by 13% year over year. On the bottom right of the slide, you can see data usage per customer has grown by 56% year over year to close at 421 MB. Thanks to our segmented marketing approach, customers have significantly increased usage through data bundles. The pie chart on the right-hand side shows that more than 90% of the usage is now in form of bundles, which offers our customers better value and freedom of usage. To move on to EBIT margins, as I said in the first slide, improved by 2.4% year over year on an underlying basis. Ladies and gentlemen, excluding the one-off adjustment in the prior year, this represents a 18.3% growth year over year. The 2.4% improvement was driven by profitable service revenue growth, resulting in contribution margin improvement, effective cost management resulting in no increase in cost in relation to revenue, and very prudent CapEx investments. During the year, we invested 36.4 billion shillings, as you can see from the bar chart on the left side. Most of this investment was done to increase capacity to serve the demand for high-speed data, which is growing very rapidly. 11% of our CapEx was spent on building a stronger and wider fixed network. Further, almost a fifth of our capex was invested in IT or information services, where we now have better than ever custom analytical capabilities and superior capabilities to offer personalized propositions to our customers. Effective and efficient capex investment has been complemented by successful commercial monetization and revenue growth. As a result, despite increasing capex investments year over year, the capex intensity, which is capex as a percentage of revenue, reduces, as you can see in the line graph in the left-hand bottom of the slide. This, we believe, gentlemen and ladies and gentlemen, will result in superior shareholder returns. Safaricom's capex intensity is still higher than the benchmark rate of most of the global telcos of scale. To move on to cash flows, our business continues to remain strong and generate healthy cash flows. From the waterfall chart, you can see a healthy EBITDA of 112.8 billion shillings was sufficient for us to significantly reduce our net debt by 12.5 billion shillings, pay dividends of 38.9 billion shillings, and invest 36.4 billion in capex. I'm now happy to inform you that the board has recommended a dividend of 1.1 shillings per share, an increase of 13.4% year over year. A strong closing position with cash will be used to further invest in opportunities for future in the financial year 19. To speak a little bit on the way forward, we believe non-traditional telcos is set to be the driver of growth to complement the traditional telco growths. We believe future growth will be delivered by Mpesa, mobile data, home and enterprise solutions, including Internet of Things, new businesses like e-commerce, and non-telco expansion beyond the boundaries of Kenya. On the expansion, successful expansion projects, we believe, are a result of a long process of developing the right partnerships. We continue to critically evaluate the opportunities that have presented to ourselves over the last few months and have already identified few opportunities to take Mpesa beyond the boundaries of Kenya. On e-commerce, the focus is now on customer awareness. We are enhancing our warehouse and logistic models to make them more efficient and sustainable, leveraging from our existing networks as well. We have rationalized our product range on e-commerce with a view to deliver superior customer experience. Our initiatives to improve quality of service of customers has helped us to improve our customer satisfaction scores, known as CSAT, already from 61% to 80%. On home solutions, we plan to roll out fiber to more homes this year, hopefully doubling the number of homes connected and enhancing our propositions. On Mpesa, in 2017, we introduced Mpesa One Tap, which reduces the number of steps taken to complete a transaction and making customer journey better. By the end of last year, we introduced a second innovation around payments, which is Mpesa Scan to Pay, which allows a customer to pay in 2 steps by scanning a QR code and then entering their PIN. Recently, we have signed up new partnerships with PayPal, with Google Play Stores, all of which we believe will open up the global marketplace to both local and international buyers and sellers. And finally, on Bonga, this is a product under development and is a platform designed to leverage capabilities provided by modern technology, such as smartphones, to provide a faster, convenient, and smooth experience while making payments. It will provide customers with a unified conversation and payment experience, allowing users to send and receive money while chatting without having to exit the application. The platform is still undergoing the pilot phase with select users, and the official launch will depend on the outcome of the pilot phase. Finally, I would like to leave you with the guidance for the next year. We believe that the macroeconomic conditions will improve gradually through FY19, providing a conducive environment for a company to continue to deliver growth. We are hence moving up our guidance for EBIT in FY19 to 85 to 89 billion shilling, a 7 to 12% growth year over year. We expect a similar level of CapEx investment in FY19 and hence maintain a guidance of 35 to 38 billion shillings of CapEx investment again next year. In FY19, we look to drive long-term shareholder value by deploying next generation's network services. We'll leverage on data analytics, segmentation among few. In doing so, we will be continued to be guided by our purpose, which is to transform lives. To our visa, when we get together, great things do happen.